I know where I was New Year's Eve, 1987. I know what I was doing. And the last 33 years came downhill from that. And at that point, we were a force of 4 with 1 employee. And we continued just doing stuff in San Francisco that was mostly rough and tumble, but it was less competitive then. Rates of return were higher, and it was less competitive then in terms of having to compete for assets. Mm-hmm. And it just took off from there. And it's, if you're suited to it, you can kind of be a junkie to it, which is what's happened to me.
This is the Multifamily Journey Podcast, show 33.
You're listening to the Multifamily Journey Podcast. In this show, you'll hear industry experts share tips of success and failure from their real estate investing journeys. You'll get a transparent look behind the curtain while you learn to fulfill the lifestyle you want to live and achieve your wealth goals. Get ready for the journey to financial freedom through investing in multifamily real estate. Here's your host, Blake Daly.
Hey, what's up, everybody? Welcome back to the Multifamily Journey Podcast. I'm your host, Blake Daly, and today is a fun episode. I mean, they're always fun for me, and I hope this one is fun for you too, and really they all are. And if you hear me yelling in today's episode, it's just because my left ear has not popped after, 4 days now. I've gone through 2 out of my 3 open water dive trainings to get my dive certificate, trying to do more offshore wreck dives and some of the spring dives around here in Florida. And I just cannot equalize my ear pressure. So all week I've been like turning to my right, trying to be able to hear people. So bear with me on that one. But yeah, the market right now, the real estate market has been crazy. It's going up, up, up. Buyers are feeling pressured. Sellers don't know what to do. They're just throwing out crazy prices and getting them. It's wild. And through that, I've kind of been getting down on myself a little bit, like, oh, I'm not generating enough deal flow. I'm not, reaching the next milestone, achieving my goals. So trying to been battle through all of that. And then all of a sudden it's like, boom, I'm working on 2 off market deals that look really good and super excited about those things. So I'm going to knock on wood before these sellers start acting finicky, like a lot in today's market are. So fingers crossed on those ones and hoping I can get the deal rolling. And then also learned a good lesson in the past week on the 8-unit rehab I'm doing. Learn to trust but verify. So my general contractor manages a big crew. I mean, for the crew on this 8-unit rehab at any given time is like 12 to 16 guys, and this is and he manages all that, getting material, scheduling, everything. And then he has a guy that deals with the city and gets permits. Well, on all of our commercial permits, because this is an 8 units of commercial property, the city gave us feedback. They issued like contingent permits. Yeah, you can keep working as long as you do this stuff and get us these drawings by a licensed architect that shows that you're building everything to commercial code, where the outlets are going to be, the 2-hour firewall, so this thing doesn't burn down and it's safe for whoever lives in it. So the guy who pulls the permits and deals with the city did not relay that to my general contractor. My general contractor did not get those drawings and give them to the city. So I'm trying not to like squeeze a melon and bust it out of anger and trying not to blame him. But again, really it all comes back to extreme ownership. I should have known that and had the city CC me on that email, which I have now. I'm instructed them to say, whenever you talk to the contractor, talk to me, because I need to know what's going on. So trust but verify. I'm now making sure I verify. So good tip today. If you're doing rehabs like I do, make sure your contractors are doing the right things and check with the city and the code and call up. So now I got to go have a meeting with the city next week about all that. So that'll be fun. Hopefully they don't hold up this project any longer. It's been crazy. And then also this episode today is just freaking awesome. Love this episode. My guest today, Mark Hamilton, his track record speaks for itself. He's got over 21,000 units. It's crazy. And he started, I think in the 80s and started with a duplex. He was doing just one deal a year by himself with, varying partners, raising money from friends and family, things like that, just doing one at a time, like throughout the 90s, and then met his business partner, found the right partner, and then just exploded. In the last 20 years, have added over 21,000 units. I think they're one of the biggest privately held real estate groups in the country. Like I think it's like top 10 in the country. It's crazy. He's like a Fannie Mae, Freddie Mac preferred borrower. This guy just brings so much value, so much wisdom. It was an awesome show. I got to, get some really cool questions answered, and just the conversation was really good. So I think you'll get a lot of value out of this one, hopefully as much as I did, because this is awesome. I had a full page of notes after this episode. And before we get into that, this is an awesome episode, but if you haven't checked out the other episodes, I've had some really great guests on. So go back and listen to those other ones. We talked about finding deals, talked about funding deals, talked about finding partners, really everything you need to know to build up your real estate and your multifamily real estate syndication, whatever that is, your multifamily business. So go check those out. A lot of good value in the last 30 some shows. And if you like it, please leave a rating and review. That does like just massive amounts of help to get the podcast out there and for other people to get value from these shows. Well, love helping other people. So please do that. And then just, if there's somebody, tell them about the show who, if it could benefit them, want to get this content in the right hands, help people build up their portfolios. In a competitive market like this, you really need all the help you can get. Just be armed, be a strong buyer, be an informed buyer to be able to go out and get good deals right now and not get yourself in the hot water by not having all the information. So I want to get the right information in the right people's hands. If you know someone, share this show with them. And with that, let's get into the show. All right, Mark, I got it right this time. Welcome to the podcast.
Hi, Blake. Thank you for having me on your program.
Yeah, it's awesome to have you. So I just want to get kicked off and started here. And you got a long, illustrious real estate career, but let's just go back to the beginning and how you got started, buying your first property and the lead up to all that.
Well, so how I got started was very accidentally. I thought I was heading for a career in literature and possibly academia. But before I got to that, I took a job. I saw it posted on the job board at the university I graduated from, because I was going to work for a year before going to graduate school. Mm-hmm. And I happened to be in a commercial real estate firm. And, as far in terms of what I was doing at that point, any job was as good as another, because I was just going to try to put some money away for grad school. Yeah. And the first part of that mission went just fine. And I ended up succeeding in graduate school, but it was a grind and it was very much not to my liking. And so the life that I had kind of envisioned went by the wayside. And I went back to the same commercial firm, figuring I could just tread water there while I figured things out. And a funny thing happened. My wife and I bought this. We decided we needed to buy a fixer-upper. Mm-hmm. And I don't remember exactly what our train of thought was that got us to that. But we found something that was pretty ragged in a part of San Francisco that has since become highly priced. But it was ragged at the time. This was in the mid 80s. Despite the challenges of working on a rundown building, especially when you had no credentials, we kind of got hooked on it. And in short order, my boss at the time was interested in kind of bankrolling us, per se. We bought a few more small buildings and we're really just addicted to it. And they all needed everything. They needed all kinds of work. They needed the neighborhoods to improve. They needed tough love in terms of management.
Yeah. She started out in the weeds then.
Yeah, but we both just kind of fell in love with it. And a couple of friends of ours, another married couple, were doing the same thing. And I remember the exact moment. It was New Year's Eve, 1987. One of our friends raised a glass and said, "All right, here's a toast. I think we should all quit our jobs and go into work and go into business together." And, within seconds, we all raised our glasses and said, "Here, let's do it." So I know where I was New Year's Eve, 1987. I know what I was doing. And the last 33 years came downhill from that. And at that point, we were a force of 4 with one employee. And we continued just doing stuff in San Francisco that was mostly rough and tumble, but it was less competitive then. Rates of return were higher, and it was less competitive then in terms of having to compete for assets. Mm-hmm. And it just took off from there. And it's, if you're suited to it, you can kind of be a junkie to it, which is what's happened to me. And I am not in recovery, and I have no plans to go into recovery.
I think I'm in the bed next to you. Yeah, we're both suffering from the same.
No, if this is an affliction, it suits me pretty well.
That's great. I love how, just start out with you and the friends, and that New Year's Eve party was like the leg swing, kicking the ball down the hill that created so much more. And I wanted to ask, because this is it sounds similar to how my wife and I got started. We were looking at all these fixer uppers, and I swear I could count the scolds, for all the fixer uppers that we looked at. But did you just fall in love with it right away? Like when you guys started doing it, adding the value and doing these hands-on kind of projects, is that what got the ball rolling for you?
Pretty much. And it's not rational, because the first property we bought was a duplex in a part of San Francisco that's now called Hayes Valley. And anything that could be wrong with it was wrong with it. And it was so rough, and the neighborhood was so rough, that when my wife's mother saw it, she broke down in tears. And, the rough part for them is we were engaged at the time. So she knew, knew that we were hooked. But there are lots of little things you can do every day and have to do in the multifamily business, to do your work for the day. Seen one way, there's always opportunity of things that you're going to have to deal with. And seen another way, it's the curse of having lots of things to deal with. But if you don't like ever being finished with your work, it's a pretty good fit. And over the years, I've come to think of it as a strength in numbers and a pain in numbers business, because, if you have a 100-unit apartment building and if you have 5 or 10 units vacant, that's not the end of the world. You keep the units in good shape and you meet the market and you'll get full again, right? That's the strength in numbers part of it. The pain in numbers is always stuff to do. And if you have bigger properties, you're going to have a staff that does a lot of them. And so, my maiden voyage was a 2-unit building. And, we've done, in the last 20 years, we've done properties as big as 600 units. And there's always plenty of stuff to do, and it takes a team. And if you have great people that you get to work with, the whole thing turns into something that's pretty good. It's hard to walk away from.
Yeah. Loving the story so far. And there's a lot to break apart to go from 2 units, to doing a 2-unit deal to doing 600-unit deals, and especially where you are now. So can we break down like what those early deals looked like, how you built your foundation to be able to, grow and scale the business and do these large, massive deals that for somebody like me, who's my biggest is 66, when I think about 10 times bigger than that, I'm like, holy cow.
Well, good size. 66 units is a good size project. If it's just you and your wife.
It started out as me and my wife when we were doing small multifamily. It sounds like kind of like you and your wife were. And then just through networking with other folks, a good mutual friend of mine, we created like a partnership, and we syndicated that first deal together. It was all of our first syndications, even though we, had multifamily separately. This was the first one together.
Well, I'd love to hear your experience with partnership. I think partnerships are a great thing, especially good ones. When you have investors who are passive participants, those are great partnerships to have. In 2 very different parts of my career, I've been in great business partnerships, and partnerships they're a profound difference maker. But back to the early years, our first 4 deals were a 2-unit building that we did on our own with help from her folks and mine. And then we worked on the property every night. And my brother was our hired hand. And he worked on the property every day. And then we did a 3-unit, we did another 3-unit, and then we did a 4-unit. So, our first 4 deals totaled 12 units. And then we went into this partnership with this other couple. And by then we were, kind of working between 2 and 12. And that only lasted for about 2 years, really, because the market turned down. In the late 80s, we had the S&L fiasco. And, we had a big spike in oil prices, and interest rates went up, and really anything bad that could happen to real estate did.
Yeah.
And my memories of those years are worse than my memory of last year, or my memory of 2008 or 2009. That was a rough time. We didn't have any other income coming in. And so the business.
So this was when all that crisis happened in the 80s. That's after you had already quit the job, and the 4 of you had made that decision to.
We'd all given up job security,
that's a big decision to make. Yeah, especially early on.
It's definitely hard when you're starting out and you don't have a lot of your own capital, and that's where we were. But the real difference maker is the other couple we were with. They separated, they split up, and then so we had to reorganize the businesses. And my wife took the management company and I took the investment operation. And then we still collaborated with one other person for what was then a small brokerage enterprise. And I just kept going. And so I did 91, I did a 3-unit deal. And then in 92, I did a 6-unit deal and so on. And through the 90s, there was only 1 year that I didn't buy a property. And they trended up from 3 or 6 or 7 units or one thing or another. And by the end of, by 2000, I was working on a 45-unit deal. And, my experience was that there was still plenty of opportunity in the Bay Area at that point in time because, things got rough when the moneyed households fled to the suburbs after World War II. There was things were rough in San Francisco, and they were rough in Oakland. But by the 80s, young people were coming back into the cities, and so the good part of that for us is that we were able to find opportunities and stay busy, and we had enough friends and family that knew what we were doing, that were interested, and so I was able to devote myself full time to. Well, probably not quite full time, but devote myself to finding properties and working on the properties. I became more of an asset manager at that point. I wasn't really doing much that was hands-on. My wife was running her management company, and I did enough brokerage to keep the lights on at home. And so that was how it went through 2000. In the late 90s, my partner Tony Zantz, who had a very institutional career, but wanted to do something more entrepreneurial, also started buying property with his father. And so that was, he did a couple of deals that were about the size of kind of how I was buying. And he just proposed one day, we should be partners. And I mean, I knew where he was. He was in a really good shop and had a really good, credentialed career. And I told him I thought he was making a mistake. I said, the worst thing that can happen to you is I'd say yes. But why would I say no? I said, I don't see any downside in it for me. You're going to go from being in a great shop and having a salary and the like and hoping we can work it out. I mean, if you want a yes answer, I'm in. But I think you're making a mistake. And he said, no, I want to do it. And so we became partners in 2001, right kind of plus or minus 9/11. And so then when 9/11 happened, we both walked into the office that day. We're looking at each other and thinking, what are we going to do now? And we just kept going. The first deal he and I did together was 16 units. The next year, I think we did a 70-unit deal. And, and it just kind of kept rolling. And we were blessed by having opportunity of things to work on that we could see we would like. And all of us in this business need to know that we've been helped by the collapse in interest rates that's happened over the last 30 years. With cap rate compression, I don't want to say it's easy to make money, but it certainly gives you a good push. And so then we just started building a little shop. And, it started out as me and Tony and one other person. And pretty soon there was somebody else. And by 2003, we were maybe up to 8 or 10 people. And then Kurt Halcooper joined our firm, and we could see right away that he was going to be a real difference maker. And within a few years, we made him partner. And so now Hamilton Zantz is 3 partners. We kept pulling up stakes where things had gotten overpriced and looking for the next market, and doing a good job of turning over rocks so that when I left San Francisco, then it was mostly Oakland. When Tony and I left Oakland, we went to Washington State. When that got priced out, we started looking in Las Vegas.
So basically taking, the lower cap rates, lower returns, get them into areas with higher cap rates, higher returns.
And that still seemed to have some upside through renovation, hands-on management effort. And I would say by 2004 or 5, we were probably in Washington State, Nevada, Arizona, Colorado. And we just kept going.
I want to get into all that because I think people are going to get a ton of value out of that. But to backtrack a little bit, I want to talk about the growth up to that point in 2001 where you made Hamilton Zantz and really started this the exponential growth from that point. But up through the 90s, it was you doing one property at a time, it sounds like, and having this brokerage, you said, to keep the lights on.
Yep.
So I just want to see like how that played in. I know other people have, side hustles, or maybe they're full-time jobs, or maybe, they're an agent that's trying to invest and, taking money from their active income and putting it into the passive income, building up the portfolio. Sure. It sounds like what you did. How are you able to build that? And I think we can talk about that for a minute.
Well, you're right to point to the side hustle. Kind of the investment business and buying things that I could work on. That was my side hustle, right? That was my love affair. My daytime life and my married professional life was doing brokerage, because that's just how I kept the lights on. Mm-hmm. I had been in a prominent commercial brokerage firm off and on for more than a half a dozen years in the 80s, and I wasn't interested in doing sales. I mean, what I saw didn't turn me on as much as buying deals and working on deals. But in the 90s, there was only 1 year where I didn't buy a deal. And I think there wasn't ever a year where I bought more than one. And so, going at that slow pace helped, because I didn't get out over my skis, and I didn't ever get tied up in something that I didn't have the bandwidth or the investor demand to do. It was just kind of, you're doling it out with a teaspoon instead of a bucket. And every year they got a little bigger. And then,
so that time period allowed you to basically build your foundation, build up your investor base, and just build experience in that time to then go towards the push later.
And execute, right? I never, and at that point in time, I was either doing it on my own, or I was doing it kind of opportunistically with an interchangeable set of a very small number of co-sponsors. I mean, it's really only 2 or 3 other co-sponsors that I work with from time to time. And when I wanted to do something on my own, I did it on my own. And so I did it, I did it 1 year at a time, 1 day at a time, and just kept it going forward. And I did enough brokerage. I ended up actually kind of making a surprising amount of money doing brokerage. Surprising, because I never intended to do it. And I did my I had my biggest year ever as a broker in 2004. And probably hadn't done any brokerage for 4 years, right? It just kind of landed in my lap. But you do have to keep the lights on. So we kept the lights on. Laurie and I kept the lights on through 2 primary income sources: my brokerage activities, and then as I mentioned earlier, she ended up with the management company when we kind of when we restructured that tiny little partnership. She ended up with the management company, and she was able to grow that on her own for quite a while. And then she took on a partner, and it was a really good marriage between the two of them, and they were able to grow that. So, the money to keep the lights on and pay the bills and feed the kids came in from our day jobs, and then I kept this side hustle going. And by 2001, I was far enough along that when Tony proposed we be partners, I wasn't afraid of it, because I knew I was doing okay, right? I'd come far enough that I knew I was going to be able to do it one way or another. And I kind of even put it that way. I said, if this doesn't work out, I'm going to be fine. I know what I'm going to do. You're giving up this career.
Keep buying properties, but you're the one giving up the cushy job.
You're giving up this career. And so you do have to have a strategy, unless you're independently wealthy by birth or by patent or by copyright or whatever, by lottery. You do have to have income streams. You have to have domestic income streams. That could be your spouse. That could be your day job. If you're in real estate, you're going to be part of a network of people who are doing things. You might be able to get something that way. If you're working in loan brokerage or property brokerage or one thing or another, and you get enough deal flow there, then you are going to have the opportunity to see deals, and you're going to know how to put a deal together. And, if you have good relationships with other people will be interested in hearing about it. And what I discovered is that, I woke up one day and I had a track record. I didn't have a track record when I started, but, if you have a track record, you believe in what you're doing, you're putting your own skin in the game, and you're willing to start small and grow incrementally. What we discovered is that, there are going to be people who are going to want to participate. And over time that group is going to grow.
Yeah.
When
I
Tony
think
and
that's hard for some people sometimes too. And I'm pointing at myself here too, because I just want to grow fast, right? Get that next deal before the last one's all buttoned up and running right. I've seen a lot of people kind of be the same way, focused on the growth and the number of units rather than, the experience. And I am completely guilty of this myself a lot of times. But that intentional growth is, I think speaks to what you've been able to do as one of like the largest privately owned firms in the country now, because you took it step by step and had that intentional growth. So I'm taking notes here too.
It's interesting the way you put that, because, if you learn as you go, of course, with all things. And in the early years, when there was something we wanted to buy, we looked at it. We looked at the opportunity. We looked at it against the comps and could see that there was going to be money to be made. And but renovation costs, especially on old buildings, and most of the stuff that we were buying was built in the late 1800s or early 1900s. Renovation costs get out of hand really fast on old stuff. And we were fortunate that while our costs went up, our values went up more than we thought they would. So what we learned is that just by being really cantankerous and ornery with our own budgets, right? Being really hard on the opportunity, and being really insistent that it clearly had to work, right? If we're going to buy it and go through this period where, the performance may not be so great, and we're going to pour a lot of money into it, and and the returns have got to withstand that. They've got to withstand that pressure. So, on the one hand, you could say we were hard on our own underwriting. On another hand, you could say we were real demanding. On another hand, you could say we were just being greedy. But by being really insistent and appreciative of what we'd learned at that point in time, by being really insistent about the returns, and knowing that you're going to go out to friends and family, and you don't want to embarrass yourself in front of them or have a bad deal, by being choosy, it really helped, and it helped the arc of the organization too, because we were successful, right? You're always going to do something that's not going to work out, but much more often than not, we were successful, and it helped. And so we didn't worry so much about being insistent on getting the next deal. We were more insistent about wanting to see every possible deal and then work really hard to make sure it was going to meet expectations, and then pick those deals. And by going about it that way, like I said, in the 90s, I did a deal every year and only one deal a year, except for one year. And so, I wasn't trying to dictate to the market, but I was trying to see. We were trying to see all of it and then take the ones that we really, really thought would be good. And that's still part of our ideology. And we've been able to grow into a decently sized operation, because whenever a market has gone up so far that it's harder to anticipate that kind of growth going forward, we tend to stand on those assets, or sometimes even sell them and look for the next market. And we're in 26 markets now.
Yeah, that's all really, really good stuff. I'm glad you're saying that about, just being hard on your numbers and all of that, because it's your reputation when you're raising money for these deals. And now you guys, your company is at over 21,000 units and has a $4.8 billion portfolio, which is weird because I usually only interview people with 5 billion or more portfolio. So this is the exception.
But I feel honored. And we closed 250 million in acquisitions this week, and we're already
this week.
Yeah. We're already,
so that's going to be over the 5 billion. So I just,
we're over
my own words there.
We're over 400. We're over 400 million for the year, and it's only the first quarter. So, that would be a good year in most years.
Yeah, I'm trailing you by a little bit, but trying.
That's all right. You're younger too. You're a lot younger.
Yeah, that's awesome. And I hope that inspires people, right? To where you're just saying, you started with a duplex, and then all through the 90s, you were doing only one deal a year, and now you're doing 400 million the first quarter. Like that real estate is the get rich slow game. It's you can model it. There's proven success, and you just keep going over time and building on your experiences, building on your portfolio. So that is awesome. And you mentioned something in there that I want to break down a little bit, like just knowing you and when you start investing, you've been through a lot of, several, probably a handful of downturns now and bad markets. Have you seen it, that your portfolio grows more in those times of an uncertainty when, like the Warren Buffett followers would say, when everybody else is being fearful, be greedy. Have you seen that pay off a lot, like in the, in those downturns, or has that been?
Yes and no. I mean, I missed the RTC years. If the RTC years came around now, we'd be in a position to load our card up hard, and people who had war chests back in the early to mid 90s did exactly that, because the federal government had taken over the savings and loans, and the federal government was in business to be out of that business. They were just liquidating. You bought a deal from the RTC, you were sure you were going to make money. Yeah. And so I missed that boat. And I think some number of the successful REITs in the United States got started back then. I mean, I remember reading a headline in the early 90s that Sam Zell had piled up a $400 million war chest to go out and buy properties from the RTC.
Yeah. I just read his book. It was just eye-opening, like what he was doing that time. So,
I mean, he was there and he knew what to do at the time. And at the dot-com bust, it didn't affect the kind of real estate we were buying at that point in time. It definitely helped continue in the long run, put downward pressure on interest rates. In 2008, 9, and 10, our transaction velocity went down. And again, if somebody had given us a blank check, we would have known what to do with it. But we were still raising money, primarily friends and family at that point in time. And so, we tend to have cautious capital. Yeah. We've also done a lot of business with institutions, and we certainly did some things with institutions that were kind of like buying off the rock pile. But we didn't see the last downturn, the Great Recession, that the federal government did everything it could do to keep banks afloat, right? And banks did extend and pretend. So there wasn't a lot of low-hanging fruit. The rock pile of busted deals didn't get that big. And so in 2009, we had a slow year in transactions that year. We had done 15 acquisitions in 2007 for $350 million. And then the following year, in 2008, when the world kind of got turned upside down, we did 15 acquisitions again, but the price went way down. It was, we did 15 acquisitions and it was $160 million of acquisition volume. And then in 2009, we bought 4 deals, and it was less than $100 million of acquisition volume. And then the market turned around, and where we did well economically off that was that there was some pent up demand for household formation. By the time we got to 2011, people were moving back into apartments and rents were starting to go up. And the other thing was interest rates just kept going down. And this turn of the wheel, I think there will be some blood in the water. We haven't seen it yet. And I think the blood in the water is going to be specific to property type. There'll be a lot of retail that'll get hurt. There'll be some hospitality stuff that'll get hurt. Office buildings are going to be challenged. So far, it hasn't happened with apartments. If we see wreckage in the apartment sector, it's going to be from the rough and tumble stuff where people really can't pay their rent. And you could see, although there's forbearance right now, and we're not hearing much about foreclosure activity, but I think you could see, if you're willing to really roll up your sleeves and get into the rough and tumble stuff, I think you could see some of that in the C property, the C property class. I also think that if there are portfolios that are superstar portfolios of core, ultra glossy, high rise apartments, rents are way off on those. And I don't know if we'll see foreclosure or not, but I think those income streams are going to get rebuilt. And right now, in our portfolio, we're mostly a B+ to A- operator. We didn't have any real, except for one property, we didn't have occupancy get challenged. And we also didn't have rents fall apart. We had slightly more delinquency than we had budgeted for. We had probably budgeted for 1% to 2% delinquency, and I think we ended up having 2% to 4% delinquency across the portfolio. That's enough to affect your cash flows, right? And it did. Again, in some cases more than others. But I have friends who live in that world of the super beautiful urban infill thing, and they'll tell you, right? I mean, if I asked them what their rents are right now, they might not know. And I might get the answer, we can't rent anything. We don't know. Yeah. But I think, the superstar buildings, the AA plus stuff, the rents could be off anywhere from 15 to 30%. And on the true workforce housing stuff, the stuff that's more like C property, I think you do have a lot of people who simply can't pay their rent. And you could have delinquency there of anywhere from 15 to 30%.
You're seeing it kind of be like the buns of the market, the top of the market and the lower tier of the market and everything in the middle, the meat of the sandwich there, the B, maybe even C plus, B and A minus class are pretty stable. You said they fell a little bit. And I had another large operator. I think he's got probably like 12% of the units you have, which is still a lot. And he said there was like a 6% overall decline in his portfolio, but with stimulus and other things like that, got it up like 3%. So overall is a small hurt, which hurts cash flows, but overall he's in like the C plus and was doing pretty well, all considering. It's not the highest stuff.
That's the difference between maybe I need to go see a doctor, or you're going to a doctor in an ambulance and you're going into intensive care, right? Yeah. We're firm believers in meeting the market. We learned that in the last downturn, that if we just took care of the real estate, took good care of the staff, and managed for occupancy, right, and let the rents float with the market, we learned that we were okay, because nobody wanted to move. Nobody likes to move in a downturn. They may not like to move ever, but they certainly don't want to move in a downturn. It's like, God, I don't want to go out there now. We're a couple, one of us has lost our job and now we're going to move. No, nobody wants to do that. And so we met the market. I mean, whenever somebody was saying I can get a cheaper rent over there for a nice apartment, we'd say, stay here. And so we kept our apartments full. We reduced turnover. We reduced delinquency. We reduced vacancy. And again, our NOI didn't go down that much. And so that was the lesson we learned in the last downturn. You meet the apartments, you can meet the market and play for another day. With, if you have a shopping center, you might not be able to do that. If you have a hotel, you might not be able to do that.
Yeah. That's really good insight, especially from, somebody that's in 26 different markets and seeing a lot of things happen. So overall, like the multifamily market is strong, which you're attesting to here, which is cool to see. And I wanted to ask, like, how are you financing these properties, and how has it changed for you in COVID? Like, what's your typical leverage looking like right now?
We're usually gonna put in probably 30 to 35% of the total capital as investor equity, which we're the number one investor in our portfolio. And when I say we, I mean me and my partners and our families, and staff. A good number of the staff have equity in our deals and their families.
Yeah. So I really like that. It's like skin in the game. We believe in this.
People love that, and they should, right? And it's also good for us. It underpins the organization. But we'll have, generally speaking, we're going to have about 10% of the investor capital in any given deal, and then we'll raise the rest of it through friends and family. We don't use a broker dealer. We don't pay anybody in the office on commissions. And an investor base that started out at 2 or 3 dozen back in 1990 is many, many times that now. And people can invest if they want, right? And they know how to find us and they know what we're doing. But we'll ordinarily, our capital stack will be 30 to 35% equity and 65 to 70% financing. Very often the equity is going to be equity in a 1031 exchange, which might be our own. It might be, almost always, our org chart is going to have at least one partnership that's our partnership that's doing a 1031 into the partnership.
And can you explain that? I wanted to break that out. I know when you're talking about deploying capital from those lower cap rate markets to, higher cap rate, higher returning markets, 1031 is usually a big source of that because you roll in the equity. Can you break down, what that is and how you guys are using it to grow?
You bet. In any kind of hypothetical or textbook deal that we're going to do these days. And, the part of the market that's really working well for us right now is probably, this is going to sound a little bit wide, but it's probably 25 million to 125 million on a deal. Mm-hmm. And if it's 75 million or more, we're probably going to have an institutional partner for that. But if it's 25 to 75 million, we'll capitalize that with friends and family, private client capital, our own capital partnerships. And so if it's a $50 million deal and we're raising 15 million for that deal, it's very plausible that 5 million of that would be a partnership that we have that's just completed an exchange and has money in an exchange account. And then we work almost exclusively with Freddie and Fannie. We don't do much financing outside of what we call agency debt. We do CMBS debt every once in a great while. Every once in a great while, we might do life insurance or bank, but probably 95% of our financing is going to be Freddie and Fannie. And they've become much more comfortable with the structure we use, which is called a tenancy in common structure. And so, but they don't want to have an unlimited number of people on title. So generally speaking, they're going to allow us to have 10 entities on title. And so if we're raising 15 million bucks and we got 5 million coming in from a partnership, and we have, let's say we have 7 people who have their own exchanges, right? They've sold the property, the money's at an exchange account, and they need to complete an exchange.
And these are the limited partners in the deal, correct? That are,
well, the terminology is important because the IRS doesn't like you to sell real estate and be in a partnership. That in their view.
So this tenancy in common is a whole different structure to put the deal.
Just a different structure. It's still a group structure. But instead of your investors being in a partnership, they're on title. So if it was you and me and 6 of our friends or relatives, and we each had $1 million from a property that we've sold, then we might come to Hamilton Zands and say, here's, I need to do this exchange. Can I work with you? And we'd say, sure. And so if we raise 5 million from an existing partnership and raise another 8 million from 8 people who each need to place $1 million, and then we have a $2 million gap to cover, we'll put a new partnership together, and we'll raise another $2 million inside of that partnership to put together our $15 million equity stack. And that's very much how it is. We probably 75 to 80% of our executions follow that model. And we're known enough in our home markets that people know that we're an option for helping them with their exchanges. We're really connected into the investment brokerage communities, the commercial real estate communities. And we have a lot of clients who've piled up their own real estate portfolios over the year. And mostly those folks get to a point in life where they just don't want to do it anymore, right? They don't want to take their chips off the table because they'd have to pay their capital gains, right? So what they do instead is they will put their money into an exchange account. They'll come to us, and many of our investors have done that many times over. And so that's kind of how we execute. If we say it's a tenancy in common execution, that's a very simplified version of how it's going to be. But it allows people to continue to meet the test, the like-kind test of selling real estate and buying real estate, because they're on title. They're right. The name of their own personal partnership is right on the title. So it meets the test of like-kind exchange. And then we do all the CapEx, all the asset management, and all the rest of it. And it ends up being a very turnkey experience for people who are really just tired of it.
So I got 2 questions on this. And one is going to be, these basically become passive investors. Maybe they're other operators that are 1031ing out of their properties and don't want to have to manage it anymore. And then the second would be like how that works with the SEC. So is that like offering?
Those are good questions. And so technically they're not passive investors. They meet the test of still being an active investor, and they meet that test because they sold real estate. And then how we structured this, they're buying real estate.
And they're on the title of the show.
And they own it directly. So they meet the test of being an active real estate investor. What I would say is they're well served with a very turnkey experience, right? And that allows them to say, look, I just want to go do other stuff, right? But they still meet the test of being an active investor. And in terms of the SEC, we are still a Reg D operator. And Reg D is a provision in the Securities Act of 1933 that says if you work with people with whom you have a prior business acquaintance, right, then you don't have to be a broker dealer to work with that person. And so we're not a broker dealer. A number of people in our office have the licenses. They have the Series 7, they have the Series 63, but we don't sell to the general public. And so because of that, our burden is making sure that we develop an acquaintance with somebody. We don't operate a boiler room. We don't pick up the phone and call people and say, hey, I heard you just sold this deal. You need to work with me, right? It sounds funny, but that's called selling. Right. Yeah. And if I'm working the phones and talking to a bunch of people I don't even know, and I'm just wanting them to invest with me, that's legal, but it's a different way. And we operate inside the Reg D safe harbor. And so we have to develop an acquaintance with anybody who may want to invest with us. And then we protect ourselves by the fact that we don't take anybody that we haven't gotten to know, right? We insist on suitability by our own measurement. That is this going to be suitable for this person? We deal with accredited investors. We're not dealing with people who are going to be, making capital commitments that they maybe shouldn't make. We don't pay commissions. None of our salespeople have ever been on commission. They're on the same, salary and bonus program that everybody else in the organization is on. And we've never used broker dealers raising money for us so that the investing public is coming in through a broker dealer and then going into our deals. So It really is friends and family, and people who are perhaps just getting to know us are always kind of surprised that we've been able to build a portfolio that we have as a friends and family portfolio and inside the Reg D exclusion. But we've been able to do it, and it keeps
this is awesome.
on.
It's like opening my mind to a whole nother way to capitalize deals, and especially at this scale. I'm sure over 20 years, that 20-year track record is what allows you to do it. But man,
absolutely,
this is mind-blowing. I'm gonna have to go back and listen to this again later. So
but it also, thank you. But it also keeps you honest, right? Because you're not doing deals just for the sake of doing deals. And every deal we do is going to have our own money in it. Every deal we do is going to have our family's money in it. And every deal we do is going to be a deal that we believe in. We're not just tying something up and then going out to a broker dealer and saying, hey, raise the money so I can buy this deal. They have to work. And if you're willing to be patient and somewhat demanding on your own work, you've done a few things right.
Yeah, that's really, really good. And I had a quick question I want to ask before we pivot into the next section, which is asset management, which I'm itching to kind of ask you some questions there. But are you guys like acting as your own in-house broker, sourcing your own deals, or do you have like a network of brokers that bring you deals too?
It's the second.
Okay.
We I wish we had figured out how to have one or two staff people simply devoted to calling property owners, right? So that we didn't have to wait for things to be on the open market. We've never been able to do that. Yeah. We know a lot of people, and we certainly get a story every once in a while from somebody we know who may be selling a deal, but we rely completely on brokers, from CBRE, Cushman Wakefield, Marcus and Millichap, Newmark ARA, Berkadia. And we do a lot of business with these folks every year. And one thing that's been really good for us and really good for them is that if you bring us a deal, you're going to get that deal back at some point. We're going to make sure that we give you the round trip because you brought it to us. You helped us do it.
You sell it to us, and then when you go to sell it, you'll go
back to the same person. Yeah, loyalty is important, and And so we have,
because then who's going to bring you the next deal? This guy that the repeat business.
And, the other thing we did is that when we wanted to get into the Eastern time zone, I mean, there are qualified people everywhere in the country who can perform and do a good job of it. Right. And go about it the right way. And so when we decided it was time for us to get into the Eastern time zone, it's like, well, there's already plenty of people out there. How are we going to get on anybody's radar? And what we did was we sent key staff people 3 different times to go domicile in the Eastern Seaboard and really work it, really build the relationships. And I'm sure that over the last 3 years, we've bought more property, anywhere between Atlanta and Connecticut than we've bought anywhere else in the portfolio, because we spent the time to build the relationships. But
when you foster those relationships,
people like to know who they're going to work with, right? And so, we wanted them to know us and to be able to give us a shot at it. And I don't think any of them were disappointed.
Yeah. That's great. And I wanted to ask you too, I know you started out, getting your hands dirty, really focusing hard on these properties. And then your kind of strength, it seems, has been in asset management. So I wanted to ask, what is your approach to asset management? And maybe a couple of takeaways that you've learned over, years, decades, whatever it is, that really make your properties run the most efficient.
So I could tell you what I contributed. What I contributed is a willingness to get dirty, right? And I don't mean I don't mean foul play. I mean, if somebody's going to treat you poorly or you have to contest something, well, then, when you need to battle, you battle and battle hard. But that's not really what I'm talking about. I'm talking about going out in the property and literally doing the dirty work, doing the unit walks and pulling up the carpets and looking under the floors and, talking with the tenants when things aren't going right, just really saturating yourself in all of the ebb and flow and hurly-burly that goes on every day of every month on any apartment community. There's always a lot of stuff there. So, I mean, I brought a disposition to a willingness to really get into the operation, right? To get into the gritty stuff, and to be right there in living Technicolor where it's happening. What Tony Zanz brought to the table was the training and meticulousness of the institutional world, and the asset management platform that we have in our shop was really led by him more than any other single person. But we also have a group of really terrific asset managers, and it's funny. Back in the day when Tony and I were starting, I subleased. My wife had a bit of a firm at that point. She probably had 15 people, and it was me and one other person. And so I subleased space from them, and I'd go into their office once a week and sit down at the desk and sit down at my wife's desk and go over the performance with her, and all the CapEx and all the problems and what are we doing for rents and how's our rent roll look and all the rest of that. I just go over there and talk to her every week, right? And Tony saw that I was at least that savvy about asset management, and then he took it and took it to a whole nother level, because starting in about 2006, we had outgrown the Bay Area, and we were in other markets that my wife's operation wasn't serving, so we had to go to third-party management. And at one point in time, I think I figured out that over the years, we worked with 13 different management companies. Real estate's a local business, and somebody who has a great shop in Olympia, Washington may not have a shop in Colorado Springs. That person might not have a shop in Las Vegas. So we tried to find best in class wherever we were. And going true third party is a lifesaver, right? And is necessary when you're getting started, especially if you're buying out of your home market. But at one point, it got to a point that with 13 different firms, right, it was hard to implement best practices and to insist on uniformity of reports. And a third-party operator, their primary responsibility is to themselves and their employees. And if they have an opportunity, if they see a rising star and that person happens to be on your property, but they know that they could serve their organization well by taking that star and putting them somewhere else, it became really hard to have consistency with team management. So in 2011, we decided to, and I was the last. I refer to myself as the last convert. We decided to build our own property management company, and I was hesitant to do it because I saw what went into property management. I mean, I was living with it, right? My wife did it
Tough aspect of the business
for almost 30 years and only retired a few years ago. And I'm thinking, it's like, wait a minute, you want to do a management company? I know what that involves, right? But finally, I had to play along, and I'm glad I did, because we took just a maze of different standards and staffing issues and temperaments, and we're able to replace it all with a uniform approach. And we got somebody to do it whom I had known for many years and who had worked with us in the late 80s. And she was just a star. I mean, we knew it at the time, but I serenaded her into joining us to do this thing, and she left a very solid organization to do it. But her name is Patricia Hutchison. And she was recognized, God, I forget the name of the organization. I'm going to say it's National Multifamily. It's not the NMHC, but it was a prestigious organization. They recognized her as the Management Executive of the Year 2 years ago, and she was the first woman to crack that barrier. That's and awesome. So, we now have about 30,000 units under management at Mission Rock, which is the management company, and maybe not quite. More than 2/3 of that is our portfolio, but then I'm coming back to your question here. So our asset managers, their job is to liaise deeply and frequently with their counterparts on the property management side. And they all speak the same language in terms of looking at the reports. They all speak the same language in terms of dealing with CapEx. They all speak the same language in terms of, are we going to do concessions or not? And
so that makes whoever's job to go over those reports and keep everybody accountable makes their job much easier because there's uniformity across the portfolio. It's
impossible to do otherwise. Yeah. And so, but it's also a real morale booster because everybody's on the same page. Mm-hmm. And, if we had properties that we couldn't support with Mission Rock, we'd use somebody local because it's a local business. But what we've been able to do with Mission Rock over the last 9 years, create that dovetail when we're going into a new market. And it happens, about every year or every other year we'll be in a new market. But we don't tend to buy outposts either. We're gonna buy something where we could see we have a shot at building up a portfolio so that we don't have an outlier somewhere.
But you have your economies of scale.
That's right. That's a real chore. Yeah. I mean, right now, our two smallest locations by property count, we're in the Hartford, Connecticut area where we have 2 properties, and we're in Kansas City where we have 2 properties, one on the Kansas side and one on the Missouri side. But it'd be unlikely that we would buy a property and we knew it was just going to be our only property there. It's just hard to support that.
Yeah. That's really good. That's really good. Mark, there's so much more I want to ask. I know we're getting to the end of the time here. This has been awesome so far. I've just been taking notes as we're going and learning a ton from you and your experience. But since we're at the end here, I want to transition to the
Fortune 5.
All right, Mark, this is the Fortune 5. There's the 5 questions I ask every investor every week at the end of the show. And just to kick it off, what is the biggest thing that has contributed to your success?
Liking the work and going to work with really great people.
Yeah.
And I know that sounds schmaltzy, but
I love it. That's a great answer.
Those are the 2 best things, because if you don't hate your work and you really like it, you're going to do right by it. And if you really like the people you get to go to work with, you got a real chance. And anything else is something you can learn, right? In terms of, you really want to be at 75% leverage instead of 50. And here's why. You can learn that, right? But liking the work and working with good people who have great integrity, have been the two most important things for me.
That's great. And I feel like that's just across every industry. It doesn't even have to be real estate. If you love what you're doing, it's not going to feel like work. You're just going to,
well, that's what they say. If you love what you're doing, you don't have to go to work.
Yeah, that's awesome. So you're not working, you're just enjoying it. I love that.
I like it. Yep.
Mark, what's been your biggest mistake so far that's turned into a learning lesson?
Interesting question.
So I like this one because you get the flip side of the success story.
Over leverage, over leveraging something. Lenders have a funny thing that they don't like it when you can't pay them back. Right.
I would have thought.
Yeah, they're going to be a lot happier if you can really pay off that loan. Yeah. And so, we got caught in that a little bit in the last downturn because we did an institutional partner deal, and it was with a bank. It was with their structured finance group, and then that bank got taken over by another bank when all that. And all those shotgun marriages were taking. It's probably before your time, but there was a lot of shotgun weddings going on Wall Street.
Yeah, I was probably having a teenage birthday somewhere when all this is happening.
And we had a deal that we had done that underwrote beautifully with an 85% loan. But when the deleverage, when the hammer fell in 2009, 2010, 2011, everybody had to deleverage on the loan on that property came due at that time. And our institutional partner, who was another big bank, who we still do a lot of business with, said, "We love you guys. We love how you've comported yourself with this. We're not going to answer that. We're not going to make a cash call to deleverage this loan because, we really can't. But, we'll give you each one of these properties for $1." That was the best offer I wasn't able to take because
it was just pay off the debt plus $1 for the property, or
well, not even pay off the debt. They were going to give us the property, and then we were going to have to go out and source about $25 million of capital to deleverage the loans. And so, that had a hard ending, but we comported ourselves well and still continued to do business with a number of the counterparties, including the bank that was our partner. They still originated a lot of debt for us. Yeah. And the servicer, who ended up being involved, originated a lot of debt with us. And sometimes you just have to play your A++ game, no matter what, even if it's not going to get you anywhere. Yeah. But over leverage is something you have to be careful with. Under leverage.
I appreciate you sharing that bruise too, because that'd be like, that might end somebody, right? If they had a $25 million capital call. But it sounds like the lesson in that whole scenario was, if you carry yourself well and treat people right, that you preserve those relationships, and now you still do a lot of business with them today, and you learn from that experience.
Well, I appreciate you putting it that way. It's the only time we've ever done financing above 80%. And it's the only time we ever did a fixed rate loan of less than 9 years. It was a 5-year loan, and that was enough to get us in trouble. Right. But then we instantly made sure our partner, Kurt Howcooper, put together a dossier with our CFO and one of our asset managers on the performance of our entire portfolio. Mm-hmm. And then we made appointments with senior staff at Fannie Mae and Freddie Mac, and, went to their conference rooms, and we said, look, here's exactly what's happened. Right. And how we dealt with it. Here's the rest of our portfolio. Right. And we had all the data. And left them with the binders. And they looked at us and said, nobody's ever done this for us before. Yeah. And, we just carried on from there. It's, if there's a mistake, bring it out in the open. That's one of the best things you could do.
Yeah, that is so great. I love that lesson. I hope everybody listening to this, lets that sink in, because I don't think I've heard a better answer yet to that question. That's really good.
The biggest problems are the ones you don't own. Those are the biggest problems. You own the problem, people will give you a chance. And that's always been the case with our professional counterparties and our investors. Not every deal has worked out. We only had the one problem with the 2 properties in Reno, and we've done almost 225 deals. But still, you have to own your mistakes. You'll be much better off for it in the long run.
That's really good. Really good. Mark, what's your favorite book that you would recommend for someone starting out?
In real estate or in anything?
Yeah, I guess any way you want to take it. Real estate, business, life.
Okay.
What would you?
All right. So you honestly asked an honest question, and I'll answer it for you.
There we
go. My
go.
favorite book is a book called Dispatches by Michael Hare, Herr. He was a Vietnam War correspondent. And, I read a lot. And I have 2 degrees in English lit. And and then stayed away from books for a long time, but I've been reading a lot more recently. And I could give you dozens of books that I like a lot. But Dispatches by Michael Hare. And it's so factual and so electric without flourishes. And he just tells the story of what it was like for him to be a frontline correspondent in Vietnam in 1968. I recommend it to anyone. It's an electric book.
That's awesome. Factual and electric. It sounds like a two major English lit person describing a book. I like that. Mark, what do you like to do outside of real estate, outside of doing deals? What's your hobbies?
Well, I like to do what I'm doing right now, which is hanging out. I like to hang out with people. I'm hanging out with my wife. We have a home near the coast in Northern California that has a big garden, and it's sunny. And the garden is on its way for the year.
Well, yeah, my wife just planted too.
Yeah, I mean, I just love hanging out with people. And other than that, fitness and travel, reading. I love going to the theater. But if I had to content myself with one pastime other than work for the rest of my life, it would be hanging out, and I'd be just fine.
That's great. I'm right there with you. Hey, so this is normally the Fortune 5, but I think this warrants a 5+1. So before I get to the very last question, I want to throw in a bonus. With all the, this big portfolio that you have now and all the success, where do you see yourself and the company going in the future? Like, what's next for you guys?
That's a really great question and a really important question. I always really like it when I'm talking to investors and they ask a question like that. Sometimes they ask, how much longer are you going to work? Right. And it's so important because people need to know what our plans are. Mm-hmm. And so this started on less than a napkin, right? It was my wife and I who did not know what we were getting into and had very little money.
I love those stories.
My parents co-signed on our first loan for us. They were school teachers. And my wife's parents, we put in what we had, and my wife's parents loaned us more money than we put in. And, it took off from there. And it got to a point where, as the years went by, we did bigger and better stuff, and there was more rigor involved and all the rest of that. But you got to have a plan. And so, it's not hope, right? It's not hope, and it's not wishful thinking. It's nice to have those things, and it's nice to have joy in your work, but it can't just be about that. And so, I always tell current clients, but also prospective clients, that we're building for the future. And, we've never had a target for growth in any given year. We've never done intentional growth. We've done growth that we're receptive to, and growth that we get behind and are certainly intentional about, but it's not just for the sake of growth. We like finding the deals that we think make sense and doing those deals. And I was just talking to a colleague a couple hours ago, and sometimes a client will ask us, why are you guys still doing deals, right? And my answer is always this. We have 3 things we have to do, no matter what else, but there are 3 things we have to do. We have to be able to help you take your chips off the table if and when you want to, right? Whenever that time is. It's your money. We work for you, right? And it's not as fast as getting it out of a brokerage account or an ATM, but it's your money. And if you want your money back, that's our job. So we have to be able to offboard people when they want to be offboarded, but we can't have it be disruptive to the organization. So, we're still buying deals. We're buying the ones we like. We're growing incrementally. That's what we do, right? And by doing that, then we can we know for sure that we can offboard anybody whenever they want to be offboarded, and it's not going to hurt the organization. And so the second thing is we have to retain our staff. We have really good staff. And if we're not retaining them and providing them with long-term career upside, then how are we going to A, take care of your assets that you have with us, and B, also help you offboard when you want to be offboarded, right? And the third thing is, very often it's almost funny. We'll have an investor who'll say, I've got a lot with you, and I ended up doing a lot more than I thought, and I think I'm just going to sit tight where I am right now. but if you have something really good, make sure you tell me about it. Right. So people like hearing about the next deal. And so for us to do our job, we have to double down every year on the organization to keep the great people that we have and create long-term incentive programs for them. And I would say at Hamilton Zans, there are 3 senior partners, but we have 15 other staff that have equity. They have equity either in the properties, or they might have equity in our promote participation. And we're heading toward a structure where senior staff will have real equity in the organization. And that's all in service of being long, right? We want to be long. That's what's our plan. Our experience tells us that if we do our work well, we will continue to grow incrementally. We have 3 other platforms. We have an office building investment platform, and then we have 2 management companies. But we always take them slowly. We're not afraid of baking up new businesses. But our job is to be long, and that's what we're doing. That's our plan.
I love that. That's a great answer. I'm excited to see where you guys keep going. That's just really cool to hear. So last question.
Call me in 10 years, I'll still be there. You call me in 11 years, I won't, but somebody else will be. That's just as good.
All right. We'll do another one of these before that time comes, and we'll do a recap. And there's still so much I wanted to dig into, but yeah, we'll definitely have to do this again. This has been fun. So last question here, Mark, where can people find out more about you, or the company connect with you, or maybe even invest?
Well, thank you for that. Our website tells the story very well, and it's very plain spoken. It's nicely designed, so it's easy on the eyes. It's not, pages and pages of narrative or tables or graphs or one thing or another. The website tells it very well. So that's one way. But people can also email me if they want. My email address is Mark, M-A-R-K, at Hamilton, Hamilton, Zanze, ZANZE.com.
That's awesome. I hope hopefully your inbox gets some hits, but not too flooded, so that you can answer some questions. Mark, this has been awesome. Thank you for providing value. This has been like one of my favorites so far. Just we hit everything, and there's so much more I wanted to hit, but thanks for coming on the show. Really appreciate it.
Well, Blake, I really enjoyed it, and I hope that we do have a chance to talk again.
Hey, we're going to do it.
Good. All right. And good luck with your stuff.
All right,
you've gotten bitten by the bug. There is no cure. So just
I got the fever. All right. We're out of here. Hey, thanks for listening. If you like the show, if you found value in it, please go to iTunes and leave a rating and review. If you want to check out more on your multifamily journey, go to multifamilyjourney.com, where you can get free resources to start your journey and figure out your path. That's multifamilyjourney.com. But more importantly, go take action today towards your financial future. See you next time.